Hello, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. And today we're going to be talking about kind of a fun topic. How do new business owners or startups use retirement accounts to fund a new business? So with most new entrepreneurs, one of the biggest challenges, I have this great new idea, but how am I going to fund this thing while I'm building up revenue? And most new entrepreneurs have to resort to the traditional funding strategies, which is I go around and I ask my friends and family for money, or other new entrepreneurs will go to banks. But the problem with going to banks for a new business is your business has no revenue. So the bank is going to want something as collateral for that loan, which usually means the equity in your house. So that just puts added pressure on a new business owner saying, if this startup business doesn't work, not only am I going to be looking for another job, but I could lose my house in the process. So a lot of times we will talk with new business owners about the third option, which is there are ways to use your retirement accounts without having to pay income tax and penalty to gain access to that cash to fund a startup business. And they're actually called ROBS plans, R-O-B-S. And what ROB stands for is Rollover for Business Startups. It's a special provision within the tax code that allow business owners to essentially roll over existing 401ks and IRAs into a startup company's 401k plan, and then use those assets tax and penalty free to pay the expenses of a business. Now, while I'll give you kind of a 30,000 foot view of how exactly this works. So what happens is you establish your new startup entity. That entity then sponsors its own new 401k plan. You roll over your balances from your existing 401k plans and IRAs into your new company's 401k plan. That 401k plan then purchases shares of stock in your new business, and that essentially is what gives you the cash. The money goes from your retirement account into your business checking account to essentially fund the business. So while that seems simple from a 30,000 foot view standpoint, there's definitely a lot of rules that you have to follow and be aware of as part of this process. So we'll kind of take them one by one. So if the first step in the process is to establish a corporate structure for the new entity, here's where the first restriction comes into place. This ROB strategy only works if you establish a C Corp. So when you establish a new business, you can establish it as a sole proprietorship, a partnership, an S Corp, a C Corp. The C Corp is the only structure that works for this funding strategy because a C Corporation is the only one that's allowed to sell shares to a retirement plan. Doesn't work for an S Corp, doesn't work for a partnership. So just know that when you go to set up your entity, if you're looking to utilize this funding strategy, has to be a C Corp. So we get the C Corp set up. The next process is I need to now set up a new 401k plan underneath that entity to essentially sponsor. So I have somewhere to roll over my balances to get this thing funded. So usually you can talk to 401k providers, you get the 401k set up. It's a 401k that's very similar to other 401ks. There's employer contributions, employee contributions, loans available, everything you would expect out of a 401k plan. But there's special provisions in the plan that allow this ROB strategy to work and to use your company as a funding vehicle. Now, this is important because most 401k providers you will find don't even know much about this ROB strategy, let alone will allow you to do this. Because when you're investing the 401k assets, you're investing it in a private C Corp. A lot of 401k providers will say, well, you can get the typical list of no-load mutual funds, but we can't allow you to do this specialty investment in your own company. Because when you go, and this is important to understand, so when you have an investment in a 401k, you have a custodian. The custodian is one that holds the assets of your 401k plan, and you need a custodian that will allow those special shares. And those special shares, the term that they use to describe this, you're either going to be what's called a private placement or an alternative investment. And when you have those type of investments, typically big custodians like ours, Pershing or Merrill or someone else like that, there's actually a special process you have to go through for them to say, yes, we will hold those shares. Because it's the job of the custodian to be able to put on that statement each year how much are these shares worth? So they need a methodology to value the shares of your company each year, and those requirements are going to change from provider to provider. And it's very, very important to understand right out of the gates that if you're looking to use a certain 401k provider and a custodian, that one, they can handle this type of plan, but also what the custodial requirements are going to be to hold those shares. Because some custodians will say, well, in order to value the shares of your company every year, we're going to need what's called audited financial statements. So that's when an accounting firm comes in, they look at your books and records and say, yes, that $10 per share for your company that the 401k owns, that's a legitimate share price because we audited the financials of the company. Now the problem with that is audited financial statements are not cheap. So for audited financial statement, for an accountant to audit your books, you're probably looking at a minimum $8,000 a year plus, which you can see can get very cost prohibitive very quickly. So a lot of times, if you're a startup and you're looking to use this ROBS plan, you gotta make sure the custodian that you're working with, they're willing to take the value of your shares, whatever their methodology is, without audited financial statements, unless you, for other reasons, you've already got audited financial statements and it's not a problem, but just know what they're gonna require each year going into it. So essentially, 401k plan, you set it up, this transaction happens where the 401k plan buys the shares of your C Corp and then the money's put into your business checking account and you're good to go. Now, it sounds great. There are some requirements when that money makes it into your business checking account. And I think the conversation that I have right out of the gates with a lot of business owners is what you can spend the money on and what you can't spend the money on. So when you're a startup, and let's say you've left your job, your typical W-2 job, and you've decided to start up this business, it's not just about funding the expenses of the business, it's also how am I going to meet my own personal expenses, my mortgage, my car payment, all that stuff. I need to be able to pay myself. This is one of the biggest restrictions and no-nos of the ROBS plans are you as the business owner are not allowed to pay yourself compensation out of this pool of money that came from your 401k account. And it kind of, when you think about it, it makes sense. If you took the distribution directly from your 401k or IRA without the use of this ROBS plan, you would pay ordinary income tax on that distribution. And if you're under the age of 59 and a half, you would also pay a 10% early withdrawal penalty. So you can see very quickly, if I'm in a higher tax bracket and I'm getting hit with a 10% withdrawal penalty, I could be parting with 40 to 50% of that balance, which then does not make it an advantageous funding strategy for my startup. So the IRS does not want you to circumnavigate the tax rules and then be able to just pay yourself out of the C Corp and avoid all the other stuff. So that's why they kind of put the restriction saying you can't pay yourself with those funds. However, this funding that you got from your 4 can pay all the expenses of the business. And then if you have a revenue stream coming in, as long as you're showing revenue, then that revenue can be paid you as compensation, but you need revenue. I mean, software development firms, sometimes it takes them a while because they're building software and they're waiting to get clients, so there's a longer stretch. There are strategies that we put in place for clients that help us to get around this issue. It involves not only setting up a ROBS plan, but using other rules within the 401k IRA world that say we can free up some assets to pay yourself for a little while you're getting the revenue stream up and running. But that's a more complex strategy, which is kind of beyond the scope of this tutorial. So reach out to us if you want that one. So I'm gonna go over some requirements of the ROBS Corps to set these things up. So the first requirement is the funding vehicles. So where you're rolling the balance from, they have to be pre-tax. So this strategy does not work if you have Roth IRA, Roth 401k. Those are not eligible for this kind of Roth funding strategy. It has to be pre-tax 401k, SEP IRA, like IRA assets that have never been taxed before. You typically need about $50,000. When you aggregate all your accounts together and pour them into your new 401k plan, we kind of say you need at least $50,000 because when you talk to these ROBS providers, these firms that specialize in setting up and executing these types of plans, typically in order to just get the thing off the ground, there's an upfront fee to get everything established, which can range from about $4,000 to $5,000, which you have to pay out of your own pocket. That's not something you're able to use your retirement assets to pay. So it's like, so in order for it to be a cost-effective solution, you need to be using enough assets from retirement accounts to kind of offset that cost. Now, the other thing is, if you're rolling balances out of a 401k plan, a simple, a SEP, it cannot be from your current employer. So we'll have entrepreneurs all the time that are working for someone and they decide, hey, I'm going to start this gig over here on the side and start building up this startup business while I'm still working. You are not allowed to roll over a pre-tax balance from a current employer and then execute this Rob's funding strategy. It has to be from a former employer. You cannot be employed there anymore. Then you can roll over your balance and execute the strategy. Let's see. You have to be an active employee in the business. So, or in the accounting world, it's called you're materially participating in the business. So you can't just, a lot of people will jump on this and say, oh my gosh, can I take a rollover out of my 401k plan, do this Rob's plan, and start buying real estate in an LLC? That usually doesn't work because most business owners of LLCs, they're considered passive because it's not active. You're not spending 1,000 hours a year participating in the business, and you have other employment which is providing most of the revenue. So unless you can prove that you are an active employee of the business, the Rob strategy does not work. So the other thing that I talk about is, we've talked a lot about startups at this point, but actually Rob's plans can be used for more than just startups. We've had clients that have found existing businesses and said, I need assets to buy this existing business. It will already have revenue. Rob's plans can be used for that. You can enact this strategy, get the funds to essentially buy out the former business owners, and then start assuming control of the company. We've had clients that have franchised a business using the Rob strategy or recapitalized their current business. Now, when you get into these existing businesses where there's employees or you're recapitalizing, there is one thing that kind of triggers from the 401k side is, and there's a rule that says if there's an investment option in a 401k plan, that investment option cannot be allowed to be offered to just the business owner. And when you think about it, you're making the shares of the company an investment option in the 401k plan. If there are other eligible employees besides you, the business owner, so if my 401k account is able to purchase shares of my business and there's other eligible employees, they have to be given that same option. So that's obviously usually something that is a deterrent, because I don't want my employees to own a piece of my company. That's not what I was designing this to do. That's why it tends to work better in startups where there are no employees yet, because even if I plan to have employees at some point, that's okay, because I can always change the investment options in the plan. It's just here and now when I set up the plan, when I do this kind of stock purchase, like all the employees that are eligible, which may be just me right now, like are eligible to purchase those shares in the company, then literally the day after this is done, I can change the investment options in the plan to say, this is no longer an option for future eligible employees, which fixes that problem. But when you have existing employees, you just have to be careful. We've talked a lot about the benefits of setting up these Rob's plans, but there also are some cons. And I think probably the number one con that I always address is, you're using your retirement assets to fund a riskier startup business. So essentially, startup business doesn't work. Not only, again, are you looking for another job, but you've just depleted all of your retirement assets. If you're 30, 35, and you've got plenty of time to work more, that might be less of an issue than a new entrepreneur that's 60 that says, hey, I was planning to work for 5 or 10 more years. If I deplete all my retirement assets, that puts me in a really difficult spot. So just consider that before executing this. The other thing that can be a con is, as I mentioned before, you have to sponsor a C Corp in order to make this funding strategy work. The C Corp may not be the most advantageous corporate structure for you. It might be better to be a partnership or an S Corp or a sole proprietor because they're less costly to maintain. Like, you want more flexibility with how distributions are made to owners. Like, there's a bunch of reasons why you select one corporate entity over another. You don't have a choice. Again, C Corp is the only structure that works for these entities. On the retirement plan side, so a lot of times startups, when you're a startup business, You're just trying to make your concept work. Like, you're usually not making contributions to retirement plans. It's kind of like an afterthought that once the business is up and running and I have income, then I have income I have to protect. But with startup plans, when you start having employees, normally they will start a lot of the times with a SEP or a simple IRA plan, something other than a 401k that's less costly and less of a headache to manage. But with this funding strategy, it has to be a 401k plan. And that 401k plan has all the requirements of a normal 401k plan, which is you need an administrator, an investment advisor. Usually the administration of these plans, outside of that initial $4,000 or $5,000 that you have to pay for the ROBS provider just to get this thing set up, ongoing administration of a 401k plan probably will run you about $1,500 to $2,500 per year, because there's discrimination testing, 5,500 filings, plan documents, all the good stuff associated with a full-fledged 401k plan. So you just got to be ready to have those costs, because it's the only type of retirement plan entity that works. Now, I already mentioned about the business owner can't pay themselves. Audit risk. I mean, you are using these plans to kind of get around having to pay income tax and penalties on the IRA distributions. Anytime you have one of these, the IRS can always come in and audit these and test them to say they're hoping you didn't follow all the rules, or you didn't know all the rules and you missed a step. In that case, the whole thing is disqualified and you owe them taxes, penalties, and all the nasty stuff that you did in this whole transaction. So that risk can be managed by working with providers that understand all the rules and make sure you're following all the rules. So if there is an audit, you don't have to sweat it. But just make sure, again, you are working with someone who knows these plans inside and out. There's one piece of these plans that's a little bit more complex, and it comes further down the road in as an entrepreneur. When you go to sell the business, which we all hope to get there someday, that at some point you sell the assets of the business, there's two types of ways you sell your business. There's an asset sale and there's a stock sale. Stock sales are no problem with this ROB structure. Your 401k owns the shares, someone buys the shares of your corporation, they give your 401k account the cash, and we're done. Asset sales, so if you end up doing an asset sale at the end of the day of your company, the ROB structure does makes things a little bit more complex. It can be done, but just know there's some more complexities on the back end when that happens. The other thing I'll mention while we're kind of talking about ownership of the company is, when you decide to fund your new entity, like so let's say I have $200,000 in a former 401k plan, I'm going to roll that into this new ROBS plan and then fund that $200,000 is going to own my business. If that is the only funding vehicle for my business, technically my new 401k plan owns 100% of the business, which is not a great thing, because if you think about it, so if all the shares of my new C Corp are now owned by my 401k account, if I want to bring in more investors, if I want to bring in a partner and share equity, I don't have any other shares to distribute to those people to allow another round of capital to come in. So normally when we're talking with new entrepreneurs, it's like, okay, if you need to use that for your main funding vehicle, fine, but you can also combine this strategy with the traditional funding strategies of, hey, I got some money from friends and family, I took out a home equity loan to fund a piece of it. What that does is, if my 401k plan only owns half or 60% of the business, I have that other half that is kind of freed up, that as the business grows and I pay down those, I'll have some shares that I can distribute for future rounds of capital. So something to think about there. Again, these plans, if you have any questions about them, please feel free to contact us at moneysmartboard.com. Thank you.